Thanks again for everybody for signing up and joining us. I imagine we'll have some folks come in as we jump off into this presentation. I'll go ahead and introduce myself. My name is Caleb Talley. I'm the Director of Marketing and Events at Startup Junkie. For those of you who may not be familiar with our organization, I know we had signups from all over the place, including Belgium today. But Startup Junkie is a mission-driven organization based in Northwest Arkansas, and we exist to support, inspire, and educate entrepreneurs and innovators by providing no-cost, one-on-one consulting, events, workshops, programs just like this one here you signed up for today. We remove barriers for historically underserved populations by democratizing access to entrepreneurial resources and providing strategic support to any individuals seeking to establish or grow their business. And we're excited today to have Andrew Goldner. He's a founding partner and CEO of GrowthX. He's been in the technology sector since 1998, based in New York City, Hong Kong, Singapore, and Palo Alto. If I'm not mistaken, he's probably calling us today from Nashville.
Yep.
And we are so excited to have you with us today, Andrew. Consider it an honor to host you, and I will turn it over to you now.
Well, thank you very much, Caleb. I appreciate this opportunity. Aligned with the organization in many ways, most especially, I think, education, finding folks who've been previously excluded and try to welcome them in. We definitely share that philosophy with you guys. In fact, it's one of the reasons that, we primarily focus on as venture capitalists, helping founders go to market, because the reality is that maybe more than so many things actually does reduce the barrier to entry, right? It enables more people to use entrepreneurism to create prosperity for themselves and their families, which leads to growth and jobs in their communities. Because, ultimately at the end of the day, the subject that we're talking about today is important, but we also believe that there's nobody better to raise money from than your customers. They don't take board seats, they don't ask for equity, and I just want you to help them. So our focus on go-to-market really does further that same mission. Just quickly, administratively, as people kind of settle in, I'd love for this to be interactive. And so I'd love for folks, to turn their videos on and come off of mute. If they've got a question, they might want me to delve a little deeper into something I'm doing. You might want to share an anecdote on, an experience that you had that's related to the point that we're talking about. And so I think this should make it a lot more interesting to everybody if we talk about the things that you want to talk about and not just the things that I want to talk about. If for whatever reason you prefer, if you have a question that you want to drop into the chat, feel free to do that. And maybe Caleb, you could help me keep an eye on that, because I think it's a little tough to do when I'm sharing the screen. And with Zoom, when you're sharing a screen like I am, I can't see everybody at the same time. And so the other thing I would say is, today is not the day to be polite. Please interrupt me. And I mean it. Like, this is going to be better for everybody involved if you all lean in and interrupt me, so we can really get into the things that matter the most to you. And so I might not be actually looking at you if you're signaling to me. So feel free to just come off of mute and interrupt, and also feel free to just drop something in the chat, and we'll get it that way as well.
And I'll happily keep my eyes on the chat. And if you don't want to unmute or you don't have access or whatever, you can throw your hand up and I'll look for that too.
You can digitally also raise your hand, right? If anybody wants to do that too. But really just super encourage that. I'd love to have a nice conversation today.
Andrew,
go ahead.
In the encouragement of interruption, then
one thing
I would love to know is what's the traditional process for somebody to become a VC, and sort of how did you become a VC as well?
Yeah, that's great. Thank you. I'm going to take some notes here. And actually, I really appreciate you jumping in, because my next and last administrative thing was to do just that, to say, please, to kick this off and make sure that we cover the stuff you want to cover with. I'd love if more people would follow that lead, come off of mute, say hello, and just quickly, what would you be disappointed if you left today and didn't learn, right? This is really important. What do you want to talk about today?
Hey, Andrew, this is Naeem Qasim. I happen to just be looking at a prior meeting, and I saw your guys' invite out there. So I'll be honest with you, I'm blessed to even find this opportunity to listen to what you're about. I did a little bit of research before we started the meeting about you. I'm very interested in someone that's willing to share their knowledge to the degree that you guys seem to be doing, and really look forward to the conversation. And I think as we go along, I'm a chatterbox, so I'll probably have a lot of questions. And if I don't, I'm just really interested in what's going on and deeply thinking about what you're saying. So
thanks, Naeem.
I'm not trying to be disrespectful if I'm not asking either. So thank you for this opportunity, and thank you for making this venue this easily accessible to folks like myself.
Awesome. Thank you, Naeem. I appreciate that. Anybody else want to jump in with a question?
Yeah, Andrew, what I would love to myself get, and for other entrepreneurs as well, is knowing, if venture capital is right for them, and if so, when is the right time to raise?
Yeah, such a great question. An important question. Okay, I'm going to do one more call out here for questions, and then I'm going to jump into what I want to talk about.
Yep. Hey, Andrew, Jason Bigby, how are you doing?
Good, man.
Good. Hey, just kind of one thing to kind of hit on, I believe Parker was who mentioned kind of wanting to learn about being a VC and things like that. And obviously it's a line that our family office is looking in right now. But one of the things, a question I have for you in that scenario of a VC model where, you guys are, say, have a portfolio of, say, 10 companies that you're going to invest into. One's going to pop, 5, 6 are going to totally bail out, a couple other pay themselves. I know there's no perfect scenario, right? But if you could kind of talk through when you look at thinking about being a VC from a mental perspective, right? Saying I'm going to do that versus the business perspective of, the portfolio and how you're looking at gauging that. I think that would be something maybe just to kind of hit on top of what Parker was saying. That would be really helpful.
Awesome. Amazing. I don't even need to write that down because I have like a bunch of slides on that topic.
Perfect. There you go.
Yeah. In fact, I end up usually going geekier than I should on that subject. And so listen, if this group wants to talk more about that, we can. To be honest and rational, we've only got a little under an hour and a half. And I teach an entire subject, a course on this at Vanderbilt University, both graduate and undergraduate. And so, and oftentimes when I do these workshops, like I just did one in Sioux Falls last week, and we did it for like a day and a half. And so I'm hoping this is just like a teaser, and you're like, wow, we want more. So you can tell these guys that you want more, and I will happily come back. So I do apologize that some of the stuff we're going to go through pretty quickly today. I didn't pare back the slides because I want you to kind of just see the depth and breadth of what we might want to cover. But a lot of this stuff I am going to go through pretty quickly. But again, as I'm going through it, Naeem and others, don't be shy. Raise those hands or just interrupt me. So quickly,
just to add to the list before we jump in, I'd be curious to know what are the typical skill sets you need on the VC team to make sure that you've got all bases covered, and then what are the different types of VC firms? I know there's like an evergreen is one I've been hearing about.
Yep. Awesome. Okay, good. I love it. We got a mix of both founders that are looking to raise and people that might want to become VC. And by the way, I love that there's a mixture here because they're not mutually exclusive. Like today, the approach that I'm going to take, and I always take with this, is that in many ways, as a founder, if you are thinking about ever wanting to raise venture capital, you ought to be interested in and wonder about what it's like to be and become a VC, right? Because getting into the minds of a venture capitalist and understanding what this asset class is really important to do that really well. So let me launch in here. So I'm not going to spend any time on this. You can go to growthx.com. I'd love to answer your questions if you see something you want to ask about, but I don't want to spend time on this. I will pause here briefly. Back to something Naeem said. I think we're all blessed to be here today. Only few people get the opportunity to be a part of a program like this. The Startup Junkie is awesome to put it on. And so I think part of everybody being here today is not only an opportunity, it's also it's a responsibility. And so if you happen to hear me say something today that's worth repeating, and I can't promise you will, but if you do, you know, shout it out so that the people who aren't blessed to be in your chair today can benefit from it, right? That's part of our responsibility. And that's how we also lower the barrier to entry, because there's a whole lot of people in this world that didn't even see the invite, wouldn't have been included by no fault of anybody's directly. But the more we can shout out these things and get it to places that aren't where we are, the more people who aren't us are going to have the opportunity to benefit from it. So that's who I am. I'm A. Goldner at GrowthX VC. You can also find us very easily across all the social channels. Oh, quick. Also this is our North Star, right? If you're going to give me a microphone and an audience, I'm going to preach. All right. And a lot of the times it's the gospel of go to market, but you're also going to get our worldview, and this is it. And this is only one worldview of it. There's a lot of venture capitalists, and we historically have not behaved this way. But part of the reason that I am a VC, to get to that first question, is because I wanted to practice it differently. I've been involved in the tech ecosystem as the introduction, as Caleb was kind enough to share, for many years, a couple decades now. And for most of those 20-some years, I had no interest in being a VC, because for most of those 20 years, I was around VCs and I did not like the way they behaved. And therefore, it didn't seem like it was a profession for me. And only when I realized and perhaps had built up the skill sets and some of the confidence and the experience to go at it on my own. And so to the question about how I became a VC is, I decided to form my own fund with people who I loved, so that I could chart our own course and do it differently. And this is our North Star, right? The idea of the founder-funder power dynamic, we just completely reject. We won't even entertain a conversation about being more founder-friendly, because it assumes a power dynamic that we just don't buy into in the first place, right? This is a shared opportunity for us to build something as partners and do something that's bigger and more important than just the customers we're serving, you know, the product that we're selling, and, you know, ultimately the big company that we want to build. It's all about doing things in a long-term, sustainable, healthy, nonviolent way. And that is the GrowthX worldview. That is my personal worldview. And so just know that the lens with which I'm coming to you today is this. And again, if I'm given a microphone and an audience, no matter how size the audience, you know, I want to try to make an impact and hopefully edge this forward. So founders behave differently and funders behave differently, and we can get busy on the important stuff. We're going to cover quickly a little bit of these things. Some of these things we're going to go deeper than others. I'm going to do my best to keep track of time, but I can run on as well. I see that we've got about an hour and 15 minutes. Just very quickly, because I don't address it anywhere in here, and I want to get to that first question about the traditional process to become a VC. So, you know, the good news is there's more non-traditional processes to become a VC nowadays. I love that, which is dedicated to building a new and better cohort of venture capitalists, and has historically been focused on the traditional venture capitalists, is now more than ever bringing into and under the fold of the Kaufman Fellowship non-traditional models. People who are going about building a different model, building a different type of fund. And so the traditional way, studying finance, typically going to a known school, getting an internship over a summer, graduating, prior to going to getting an MBA, or maybe instead of getting an MBA, becoming an analyst at a fund, and doing a lot of deal diligence and organization work and moving your way up the ranks, and ultimately deciding to start your own fund, become a partner at the fund you're at, and oftentimes leave and just become an entrepreneur. Another traditional path to VC has been successful founders who then use some of their own capital, and because of their successful track record as a founder, use that story that forms a thesis and the relationships they've built to be able to spot other people who, like them, can be successful entrepreneurs. And being a part of that successful entrepreneur club, the story goes, you'll have access to others who would maybe chart that same course. And so using your capital and others' capital, either forming your own fund, becoming an entrepreneur in resident at a known venture capital fund, and using that as a perch to figure out what you want to do next. And of course, the VC wants you to use their business card in their boardroom to do it, so maybe they can be a part of what you're going to do. You've already proven to do it successfully. And sometimes it ends up where you just join the firm as a venture capitalist. And the last thing I'll say on the point is becoming a venture partner, which means hooking up with a pre-existing venture capital firm who believes that you have access to deal flow that they might like, and they make you a venture partner, which means you're not an actual partner of the fund. You don't get benefit in the investments that they make as a fund as a whole, but you'll have an agreement with the fund that if you bring them an investment and they make that investment, that you can, not only do you get the credit required for being able to tell other people, look, I chose this winner and they became a unicorn, and that's how you become your own venture capitalist. But the profits that that venture capital fund make off of that specific investment, they will often share it with you, and it's called deal by deal carry. And like I said, you can also follow my path as a corporate lawyer, turned deal person, always involved in the early stage, and then, had my own thesis and founded my own fund.
Before you go on to the next point,
ahead,
Scott has a comment in the chat. He said, he was also wondering about VC interest in physical manufactured hard goods. There seems to be a lot of interest in tech, but I don't see as much interest in new manufactured products.
Yep. That's a great question, Scott, and we will get to it. It all has to do with when you're raising venture capital, it's about thinking about what are the characteristics of the person that you would be raising fund that would make them relatively more likely to be interested in what you are doing. And physical manufactured goods, as well as hardware, are things that are more capitally intense. And so there's plenty of interest in manufactured goods, hardware. Obviously, direct to consumer is massive now. The entire consumer space is being disrupted because the disintermediation of the retail, the disintermediation of the wholesale. But what's really important is that if you talk to me, I'm going to be disinterested. And that's why I put it right on my website that I invest only in capitally efficient opportunities, because I don't want you to waste my time. And I mean that. Your time is valuable and so is mine. But when you're going out to raise money, if you're doing something that's more capitally intense, if you're doing something that requires more capital up front because you're actually producing something physical and not just silicon, right? Then you're going to approach an investor who understands that, invests early on, and understands that what you're doing is going to require more capital. And they're purposefully out there looking for folks like you. We're going to get into that. But I'm glad you brought it up because it's a good entree to kind of the frame of reference that I want folks to be in when they're raising capital. So this is some of the basic stuff you guys might know. I'm going to gloss over it very quickly, but just be aware VC is a form of PE, even though I wrote here PE versus VC because this is what it's normally thought of, but VC is just a subcomponent of private equity. And listen, it has its own non-obvious characteristics. And what I will say to you as founders is if you don't know the non-obvious characteristics of my asset class, then how do you know you want my asset class? If you don't know what my asset class expects of you and how it behaves and how I will behave because of the expectations of the people whose money I am spending, then how do you know you want my money? And what I have seen most regularly in startup ecosystems around the world is founders that get busy raising venture because they think they're founders and therefore they should raise venture, but they don't even know what
VC's
venture is.
Part of private equity.
It's a form of private equity. It's very early stage private equity.
The hedge fund also be considered private equity? Or is it its own?
Correct. It certainly can be, yes. Okay. And it's just a different asset class with a different thesis of investing, a different portfolio thesis with a different, expectation of returns. And I love this question. Why? Because the romance meter on venture capital is almost as high as the romance meter on being an entrepreneur. And y'all know who are entrepreneurs that really it's just like day to day, getting your fill of shit sandwiches. So it's not very much romantic about being an entrepreneur unless you're in Hollywood.
And Andrew, on that note, do you think that just because with how the venture capitalist scene has grown over the years and matured as a whole, as an industry, do you feel that it's kind of that approach and take has kind of gotten a little out of control in a sense from the romance meter of getting back down to reality?
I think that's part of it. I think the narrative that's leaked out of Silicon Valley and the narrative that's got picked up by Hollywood, mainstream media, often is the case, bears little relation to the reality of what we do day to day, just as it does what you do day to day. If all I'm reading about in TechCrunch are the unicorns, am I really getting a sense of what your day-to-day life is like?
Yeah.
What it actually takes, right?
And I think you're spot on. And I think that's the interesting thing from our approach is we've looked at the venture capitalist space to learn more about it, to understand it. We come from a corporate oil background. So what the cost of a barrel of oil is today, right? So if you're not going to get price, shut the well off and keep it in the ground, you're still in the mineral rights, right? Whereas tech, you look at companies like Uber and they're, just now becoming profitable and stuff like that. So it's just a different mindset, right? And I think that's one of the interesting things that you're highlighting on here and stuff. So
it's an asset class. It's not a commodity like oil. It's an asset class.
Yeah.
Right. And so it's its own asset class. And just because you're successful in oil, right? One of our largest LPs is one of the largest, most well-known oil families in the world, right? Just because you've done that successfully doesn't mean you know anything about venture capital.
Yep.
So for those of you in nascent startup ecosystems, trying to raise money from local investors who have a background in real estate or some other asset class who don't know anything about this asset class, be wary.
Yeah.
Right? Because when you start to raise venture, what you end up doing is you are playing a game of chess.
Yep.
And just like you sit down at a chessboard, if you're not thinking 2 or 3 steps ahead because of your experience and your intuition around the game, before you put your hand on your first piece, you've been checkmate and you don't even know. The same thing with venture capital. We're going to get into how that can happen today. But what's really important about this is guys, it's just an asset class. And guess what? That makes me a money manager. Mm-hmm. And I have a certain expectation of return for the money that I manage. And that's what's really important to you as a founder. This quote, Babe Ruth, summarizes my job probably better than anything that has to do with venture capital would. This is the asset class. And let me tell you, for the baseball fans out there, right? If you're not looking to hit home runs, then why are you recruiting Barry Bonds? If you are not looking to round all the bases multiple times, then why are you raising venture capital? Venture capital is synonymous with big fast. So anytime you think about raising venture capital, ask yourself whether you first want to be and then are you able to be very big, very fast. So, right? One of my favorite acronyms, Go Bosh. That's venture capital. Go big or stay home. That's it. A first base doesn't help us a whole lot. Do we have a question?
Yeah, sorry, Andrew, this is Naeem. You had some key points there. I was trying to go back to your initial statement, the founder and the funder statement. And as a funder, right, your risk appetite as a VC is probably pretty high. Just from your experience, what I'm interested in trying to understand is your risk appetite is very high, but what is your time expectation when you work with a founder? If you don't mind sharing a little bit of insight there.
I don't mind at all. And these are brilliant points. And I'm glad to say I've got them teed up in this too. Really quickly, most funds are 10 years long. In fact, we don't have to go in linear order. I can come back to this. Hold on. Maybe I went too far. So here's the typical fund structure. There's no rule or law about this, guys. It's just the way it's done. You'll notice it's 10 years. A venture capital fund is just a limited partnership, okay? Take a look. A general partnership, I'm a general partner, a GP. My job is to run the limited partnership. My limited partners are the people whose money I'm spending, the people in the institutions and the companies whose money I am spending. They are silent. They don't get to say anything about what I'm doing. Once they give me their money, I get to decide where that money goes. And if they don't like it, they just don't give me money ever again. I'm a general partner. I run the limited partnership. This vehicle is a 10-year vehicle. And so for your question, Naeem, where I invest at the pre-seed and seed stage, that within roughly 10 years, you all are going to be exiting for over $1 billion. So you come to me and you probably have a little revenue. You have to have some if I'm investing. You have a little revenue. Let's call it $10,000 a month or something of revenue. And within 10 years, you need to exit for over $1 billion for my bosses, the people whose money I'm spending, for them to let me keep doing my job. And this is the reality. And by the way, why does this matter to you as a founder? Because if you are raising money from me, wouldn't you want to know out of which fund I'm investing currently and where in the life cycle that is? If you know that lemons ripen faster and I'm likely going to be underwater for the first 3 or 4 years of my fund, which is about the same time as I'm going to try to raise another fund so I can stack my management fees. And we'll get to that in a minute. And oh, by the way, of the 10-year fund, the first 5 years are called the investment period. It is only during the first 5 years of a fund that I might put money into a company. During the second 5 years, the harvest period, I can only put more money into a company that I've already put money into. So Andrew, thanks for taking your time today to talk about what I'm working on here. Just a couple of questions. I'm curious, out of the fund you're investing in right now, what year are you guys? Oh, you're year 6. Mm-hmm. So tell me, is there what capital are you using now? Because let me tell you guys, if you're talking with a VC who doesn't have any fresh powder, and he's in year 6 of the fund, you're what's known as marketing material. I'm going to raise my fund thanks to you, because I'm going to go to my investors and say, listen, you need to give me money for another fund. Look at these deals I have lined up. Look at the people who want me to give them money. Look who they are and look what they're doing. And you, LP, you need to give me more money so I can get into these kinds of deals. And so go back to our North Star. If you come with that attitude that you're trying to build a long-term healthy relationship and you think, or you're going to presume, and you're going to give me the opportunity that I do too, and that you're important, your time is important, and what you're doing is important, it's a two-way street. And you're going to ask questions as well. And obviously you're going to be appropriate with them. But one of the reasons that I do these workshops around the world is I want you all to know that asking questions of your VC is entirely appropriate. And which questions to ask? Well, once you learn more about that, it's a 10-year fund, and that the first 5 years are investment, the second 5 years are harvest, That'll give you some questions to ask, right? That you might not have thought to ask anyway. And I will give you the advice that I give every founder in the world. If you meet a VC and they won't answer these questions, be polite, end the conversation, and never talk to them again, right? When you ask a question of me, which is a rational and reasonable question that an important, thoughtful founder who's invested in what they're doing and is taking it seriously would ask, you're sending an invitation. Dear Andrew, are you an asshole? And I get to RSVP. Now, if I RSVP yes, and you keep the conversation going, that's on you. But right, long-term, healthy, sustainable relationships, why would you allow someone into your life that is instantly going to create short-term, unhealthy violence, right? And so giving you the confidence and giving you the experience and the awareness of the types of questions you can and should be asking VCs is one of the reasons that it's really important that you not only spend time in this hour and a half, thanks to Startup Junkie, but you also on your own go further and go deeper. Learn more about the asset class from a VC's perspective. Learn what it is to do the VC's job. Because remember, just like when you sit in front of a customer, your job is to help them. It's not to sell them something. Now, helping happens to be synonymous with selling, but your job is to sit down with a customer and behave as if that customer looked at you and said, hey, Andrew, I could really use your help with something. If someone said that to you, would you just start spouting off about yourself? Well, you'd say, what's going on? How can I be helpful? When you're talking to a VC, that is your customer at the time. That is your same job. How do you help me do my job? That's pretty damn well aligned to how I might help you do yours, right? And if, by the way, if there's not alignment and you don't have that fit, then say thank you, be polite, and maybe at some point in the future, you'll find fit. That's why this is really, really important. So let's go back to this. We are swinging for the fences. I expect that, and this is related to a question and a point that someone made earlier. If I have 30 companies in my portfolio, I expect, and we'll get to this in a second, I expect that one of the 30 companies will outperform all other 29 companies combined. I then expect that roughly 3 to 5 of those companies together will return my whole fund again. And then the rest of the companies in the portfolio together, the roughly 25 or so, those collectively will return the fund a third time. And that 3x cash on cash return is table stakes. No one's writing me up in a magazine. I'm not going to be given the Midas Touch Award for a 3x, but guess what? I'll get to keep doing my job. Table stakes is return the fund 3 times. One company will return the whole fund. 3 to 5 companies together will return the whole fund again. 25 companies combined will return the fund a third time. That's called the power law. It is a non-standard deviation, right? A mathematical interpretation of the power law of the asset class is a non-standard deviation. So it doesn't follow the standard bell curve where everything is bunched up in the middle. It's a long tail where a very distinct few create all of the outcomes. This fun chart here is called the Monte Carlo simulation. This is a rough approximation of the asset class in terms of creating a certain returns portfolio. So again, back to one of the questions that was asked earlier, how many companies do you invest in? What's your portfolio theory around that? How much are you writing? This little geeky chart is probably more important than anything. What this basically says, look to my example of 30, right? What this basically says is if I put 30 companies in my portfolio, I have an 87.8% chance of returning my fund, which again, gets me nothing. If I just give my LPs their money back, that's a loss because I am Babe Ruth. They're not giving me money to create dividends like a real estate transaction would, right? They're not looking for me to do things that another asset class would. They're looking for very big, very fast returns. you'll notice that at 30 companies, I have about a 15% chance, pretty damn low, 15% chance to return that 4X. So if you're thinking about being a VC, this is critical. And if you're thinking about raising from a VC, this is critical. Why? Because how many companies in my portfolio do I already have? What portfolio size am I trying to get to? You can get a sense of how this VC behaves in the spectrum. How big is the fund? Okay, well, I mean, it's great that if I put an investment in 10,000 companies, I have a 100% chance of returning my fund. How am I going to get into deals if I'm giving everybody $2? Like, how big is my fund that I'm writing 10,000 checks?
Let alone your overhead.
Well, exactly. Exactly. How much overhead do I need to find?
Hey, Andrew, on that note, I want to ask you a question, and this has been our approach at how we're looking at a fund, right? And what I'm really interested to hear your take on this. So, you're looking at this saying, hey, if I put out, money into 30 companies, and that's potentially 30 separate buyers, right? For 30 separate companies, whoever wants to acquire them down the road and things like that. We've taken the approach, as we've wrapped our heads around as a family looking at venture capital, is saying, hey, we've got a core company fundamental here that we have an ethos around, that we kind of know there's our northern light or northern star, but then there's a handful of things that need to fund. But we know we have a buyer for the entire portfolio, so we can exit the portfolio in, say, 3 years, because we know we have a buyer for all of these solutions because we've built that core moat around, if that makes sense, right?
Sure.
So that's one of the things that is a little bit different, the approach that we're trying to take, where we've seen some nuances in our world where it makes sense. But I'd love to get your kind of take on that.
Listen, I think family office investing is that way. I mean, we have a saying from our perspective when we're looking to raise money, because our LPs are typically family offices, and that is, if you meet one family office, you've met one family office. And so the fact that part of the strategic rationale for the asset class for your family office is really important. And by the way, here's what I love about this point he's making, guys, okay? This is really important. If I was looking to raise money from him, if I had been approached and I was going to talk to his family office about raising money as a founder, right? He's going to invest in my company. And I said, so, tell me a little bit, or maybe it was right on his website. And I learned that having an exit in sight is a really important thing. Coming from an industry and a sector or a space that has a lot of comps and a rational path to exit, should you execute on what you're saying you're going to execute on, right? That's really important for you to know as a founder, because is that consistent with how and why you're building your company, right? Do you want to work with a VC that needs upfront to have a somewhat rational line of sight to a potential exit?
Andrew,
right?
can that cause the VC firm to be incentivized to prematurely exit companies if they're not ready but trying to close out the fund? And
how would you prematurely exit a company that's private and you're not allowed to sell your share? Right? I mean, there may be a secondary market that exists, but don't forget, you guys were talking about the sale of private company securities. The only reason that any of this is even allowed is Section 5 of the Securities Exchange Act. Otherwise, it would be entirely illegal, right? And every one of the shares that we VCs buy in this marketplace comes with a legend, and we've agreed contractually. We're not even allowed to sell it. But what is important from a founder's perspective is to just make sure that the approach that your funder is taking and their goals and their wants are aligned with yours. And if all you do is show up and spew out the details, the features and the functions of what you're doing in a pitch deck, and you don't get to know your VC, not only are you missing an opportunity to communicate to the investor that you are important and what you do is serious and you're taking it seriously, and therefore you're going to ask them questions. Would you show up to a job interview and they said, do you have any questions for me? You're like, no, I'm good. But what kind of impression would that leave, right? And so just like you show up to a conversation with a venture capitalist, you want to come prepared, not because you're looking to pretend to them that you're interested, but because you are, and being thoughtful and serious, especially as something as important as the venture capitalist that you're looking to get investment from, family office, individual or otherwise, you should have a litany of questions to make sure that you are aligned, right? Just like the founders know, if you have a customer who's asking you to do all sorts of things to your product and product roadmap, I hope you're not allowing them to do that. Do never let a customer take your product roadmap on a journey of their own. It's not a good fit. They may be a good fit later, but it's not a good fit now. Don't let the VC do that either. And so understanding a little bit about the mentality of VC, understanding the goals of the VC, understanding the behavior of the asset class, like the Monte Carlo simulation, and the fund structure and the 2 and 20 model, right? Everybody has to know this. Nobody should ever raise venture if you don't know the 2 and 20 model. The 2 and 20 model are just percentages, and what gets measured gets done. 2 stands for 2%, 20 is 20%. The smaller number is what I make. My operating income is 2% of my assets under management, right? So if I have a $10 million fund, if I'm able to talk with friends and family and others and cobble together $10 million, right? My management fee adds up to a whole bunch of who gives a shit. Because what am I going to do for $200,000 a year? I got to get an office. I got to hire people. I got to travel. I got to do legal. I got to do accounting. I got to do marketing. All this stuff, like my entire operating income of my entire business is 2%, which means, right, to the comment earlier, like, oh, 10,000, what would that cost you to try to administer? If I have $200,000 a year to do everything that I need to do, how many companies do you think I'm going to have in my portfolio? How much money can I put into each of those companies? What am I going to follow on? All these things matter. So it does matter to you, right? How I behave is going to be impacted by that 2% number. The 20% is profit. So the way the VC fund works is I get paid 2% a year to do my job, which is to take the money, invest it, and make more money from that money. When I do so, I'm allowed to keep 20% of the profit. So back to my $10 million fund. I invest all of it, minus what I have to spend on accounting, legal, and management fees, right? And I invest that money. Let's just call it 9 million for easy numbers. I need to produce at least 10 million of that 9 million because my LPs have to get all their money back before I see a dime. So when I take the 9 million and produce 10 million from it, every dollar above 10 million, I get 20 cents. So the VC, so my LPs have all their money back. There's now no more risk. They keep 80 cents of every dollar thereafter. That's how the fund model works. It's not a rule or a law. It can be 3 and 25. It could be 1 and 30. It's typically 2 and 20, and it really just depends on the fund.
So Andrew, I know there's no perfect fit here for this, right? But in your experience over the years and just with how you like to go raise money and do this, how many offices or, LPs do you try to bring into a fund, when you're trying to go at it? Because time's money at the end of the day, right? If you're trying to talk to 3 investors or 10 investors or, it
just depends. It depends, just like it depends on you as a founder, what your cap table is going to look like. Do you want to just have one VC, or are you looking to spread it out and get different types of characteristics from different types of investors who do more than just write checks? One of the reasons that we love working with family offices as LPs, like this oil company, is there's a strategic rationale. It may be for your family too, but there's a strong strategic rationale. A family office that's still operating the business that created the wealth for the family, one of the reasons that they're often interested in the asset class is not just a wealth creation of the investment fund, but to be able to spot technologies that could actually help their company either operate better internally or have an external opportunity. And by being an LP in a fund, they get an early look at the early companies that they then can begin working with as a customer, as a partner, and a potential acquirer. Our favorite LPs are ones that have both a financial and a strategic interest. And so, yeah, I mean, Jason, there's just no way to answer that question.
No, that was spot on. That's exactly how we've my dad and I've approached it, to be honest with you, is with that exact kind of approach, because if it doesn't make sense to us, then we can't have a conversation about it, right? It's not worth your time or my time, right?
Exactly right.
So, yeah, so I think you're spot on. That's what.
And you, by the way, Jason, you provide a huge amount of value. So, for instance, you know, I've got a great company that I would introduce you to that I just met in Western Canada that's saving oil companies an enormous amount of money. I introduced them to one of my LPs in the oil business. Why? One, because they understand the problem. Yep. So now all of a sudden my LP is helping me do my job because I don't have oil and gas industry expertise. They do.
Yeah.
So now they're helping me to ask certain questions or to take an angle on this investment opportunity that I wouldn't know to do, right? Two, what would be the best affirmation that this might be something to invest in? If they become a customer, right? Now, if they don't become a customer because it's not a good fit with the profile of the customers that my startup is looking to get, that's fine. If there's another reason, well, this is an early indication that there's a market problem. Three, and like you've talked about, how wonderful is it to have a community where you have companies to invest in and the potential acquirers. So my LP can become a customer, they could become a partner, they can also become an acquirer. And so, you know, again, when you, for the founders out there, asking your VC, hey, do you guys allow LPs to have direct investment rights? Do any of your LPs, are they interested in directly investing in addition to just investing through the fund? Or, hey, because of what we're doing, so I might say to you, Jason, like, hey, I'm Andrew. I'm doing this oil and gas startup. And one of the reasons that I'm talking to you, Jason, is because I want a partner that comes with more than just money. I want someone who can really help me, that has the industry experience, that can really help me understand the details of the customer problem, right? That's like, if you got that email, that's like, okay, that's a founder I at least want to talk to. That's someone who's doing their job, doing their research, and taking the right approach to this. I'm not saying every founder has to do that.
No, I can personally tell you from my dad and I's experience with him being a geologist and then me being a glass artist turned tech entrepreneur, we found a lot of common ground when I started realizing you just got to look at the data to justify whether you want to drill a hole to do the test drill, right? So you just got to look at data, right, is what it comes down to and stuff. And that's where we kind of really started aligning on, you know, how you start to look at this, because it's a different way of thinking of how you drill for oil, look for oil, or in this scenario, but you're still looking at data, you know, at the end of the day, and then taking a gut check of saying, hey, do you believe in that person, or do we believe in this idea to go start it up and fund it and build off of it? Type deal.
No, that's exactly right. I'm going to skip forward because we're taking a while, but you can see here, I mean, just what we just talked about, the types of limited partners. And we had a question about that. High net worth individuals, family offices, institutional, corporates. Like, why does it matter? Because again, my LPs don't give a crap about the internal rate of return. One of the leading indicators of the success of a venture capital fund is the IRR. Basically, how quickly are you giving them all their money back and then some? My LPs don't care about that. They're not a pension fund. They're not an endowment that's getting measured in compared to, you know, public market equivalents, PME or IRR. If my LPs don't care about IRR, you damn well know I don't care about IRR. But if I have an institutional investor that cares about IRR, the speed with which I am deploying my capital matters a ton. You need to know that as a founder based on who you're talking to. as well as some of the reasons that we talked about. Okay, I'll just quickly talk about corporate venture capital. It's very similar to the family office structure, which is typically a strategic and a financial. Corporate venture capital, for the founders out there, it's definitely become a thing. There's 20 to 30% year-over-year increase on the number of companies that are deploying their first dollar of capital. They are behaving better. They are more knowledgeable about the asset class. They're better partners. And I would encourage everybody who's going to raise money to don't just look at the financial VCs like GrowthX or Andreessen Horowitz, but look at the companies that may have an aligned interest to you. And I promise you, you will innovate and get farther than they will, right? And they know that, which is why they're taking some of their balance sheet and investing it in startups. And again, now you have a built-in investor who could be a customer, a partner, an acquirer. So take it seriously. All right, raising venture. We had an early question on is VC right and when is the right time to raise it? And we're going to kind of get into that now. So here it is, guys. This is one of my favorite slides about whether you're ready to raise venture and what would that be. Now, you know, I like to joke A is the 5th letter of the alphabet in my asset class, and it's becoming the 6th letter of the alphabet, right? Series A was so named because it was the first equity round. That's changing. But this is a good way to think about it, right? A really good way to think about it. In terms of plain English, where are you and are you ready? And what type of VC do you want to speak with? Now, hardware, it's different, right? If you are building hardware, you're not going to be as far along without raising capital because it takes more capital to get farther along. And so the VCs won't expect you to be as far along. It's not uncommon for a hardware company to raise VC pre-revenue because it's so much more capital intense to do it relative to, let's say, software. There's no excuse to be raising VC pre-revenue in software, and it would be very hard to do it unless you were a previous successful founder. But in plain English, this is a good way to think about when to raise and what type of fund to raise it from. Now, this is some of the most important stuff we're going to talk about today. It used to be that if I wanted to take an investor on, I would sell them a piece of my company. That's equity. And they had a bunch of common, and instead of selling the person the common and giving them the right to vote and sharing and all those things, they would create a class of stock, a new class of stock, and only those investors would get that class of stock, and they wouldn't be allowed to vote, but they would get preferred rights. It's obviously preferred stock, and it's what you sell when you sell a piece of your company in an equity round. And it's called, your first time you do it, you name that class of stock your Series A. That's all that labeling means. You can call it Tim if you want to. It just may be hard to keep track of all the names, so they called it Series A. And for a long time, that was typically when you raised your first money. Well, now we know that there's a lot of money being raised pre-Series A, and it's not being raised by the straightforward equity. It's being raised in these convertible instruments. Okay? Now, debt, right? Debt is different than equity because when someone has debt, that's a legal promise to repay. If you have my equity, you can't put me out of business. You may never see your money again and you can't do anything about it. But if you sell me debt, you could put me out of business. You could legally require me to sell things to give you the cash value so you have your money and your investment, your interest back. Convertible debt was like this happy medium that got built. It used to be that convertible debt was only used for so-called bridge rounds. Very quick, very easy. I'm just about where I want to be, but I'm not exactly where I want to be, so I'm not going to sell more equity. I just need a little bridge to get me from where I am to selling more equity, and let's just do it quick and easy, and let's do convertible debt. Well, nowadays, because there's so much money in the system, and because of so much notoriety of entrepreneurism, it's now being used to fund entire rounds, pre-Series A, and rather large rounds. There's, multi-million dollar convertible debt rounds, which, historically was completely unheard of. Convertible debt is a combination of debt and equity. It is both a legal promise to pay. I'm going to give you $100 and I'm going to give it to you for a year at 10% interest. So at the end of that year, you're going to give me $110. And if you don't, I'm going to sue you. And if you don't have the cash, I'm going to force you to sell stuff until it equals $110. And then you give me the $110. However, if during that year you go out and sell equity, my debt becomes equity. It's no longer a debt. You no longer are legally required to give it to me back. What I really want is that equity, and I want it on terms that are better than the equity investors, because I was earlier than them. I took a bigger risk. And that's what happens with the note cap and discount. So I sign a piece of paper. I'm giving you the money, and you're legally required to give me it back over a certain amount of time with interest. But we agree that if during that time you raise equity, my debt converts into that equity when you raise that money. Okay? And oftentimes there is a cap and a discount to make it favorable for that investor to make the investment. And that means that when I raise equity, if I price at, let's say, a $8 million valuation, you won't pay $8 million. You'll pay less than that. Because convertible debt instrument said something like a 6% cap or 20% discount, whichever is cheaper, which means when you set the price of your equity, we just said it was 8 million, I'm going to take 80% of that, or $6 million. And whatever the smaller number is, that's the price I'm paying, which means I'm going to get more shares per dollar than the equity investor, because my price per share is less. I'm going to quickly talk about convertible equity, and then I'm going to talk about why you need to pay attention to these and not just use a form that you found on the internet or a friend gave you. So convertible equity came along a handful of years ago out of Y Combinator, arguably the number one accelerator in the world, based in San Francisco. And because Y Combinator had become a 9,000-pound gorilla, they could throw their weight around because investors were clamoring to get at their startups. So they created a document that made it super easy and way more favorable for their startups to raise money. And investors just bought in because they wanted access to those startups. Well, again, because of the craziness of venture, that story has leaked out of Y Combinator, has leaked out of Silicon Valley, and it has now, imposed itself upon all of our ecosystems. And now convertible equity, very favorable to the founder. It is not debt, nor is it equity. It's nothing, right? It is literally a piece of paper that says, give me your money, and if I raise equity, you'll get some of it, but I may not. And if I don't, you get nothing. I get to keep your money and you get nothing. That's really what a SAFE note is. SAFE stands for Simple Agreement for Equity. The technical term is convertible equity. It's not equity because you're not getting an ownership stake. It's not convertible debt or debt because there's no legal requirement to pay you. I'll just give you some of my company if and when I ever raise equity, but if I don't, sorry, good luck to you. And investors around the world are investing in this. Okay? Now,
Andrew,
go ahead.
Why are investors investing in that type of manner if they're sophisticated investors?
Because they want access to the deal, period. That's it.
Okay. Do you find that irrational?
I'm sorry?
Do you find that irrational?
No, I find it completely rational. Yeah. That's the definition of rational behavior. And thank God for it. I'd rather deal with a rational human than an irrational one.
Yeah.
I want access to it. This is what I have to do to get access to it. I'll weigh the risks and the benefits, and I'll decide to do it or not do it.
Yeah.
Now, I'm going to talk to you a little about something, a little secret that I like to share. Most investors won't encourage safe notes because they're nonsense. But I'm not a typical investor. I moved from Palo Alto to Nashville for a reason. And I love being in nascent startup ecosystems. I love these kind of conversations. It's so much more rewarding than sitting around a coffee shop in Palo Alto. And so I want to share something that's really valuable to you founders that, like me, live in nascent startup ecosystems. All of us know that there are wolves in sheep clothing out there, right? The so-called VCs, the moneyed class that show up and pretend to be great, but do some things that disrupt your entire company and ultimately make you lose your company. The wolf in sheep's clothing who comes in and tries to buy up too much of the company or impose terms that don't make sense, who are either evil or just simply don't know any better because they haven't taken a course like this. See, let me tell you something about convertible debt that most funders don't tell you. I will never enforce my debt unless you turn out to be a liar or a thief. I'm going to sign a document. And by the way, most of the investments in my fund, over 40 investments in my portfolio, most of them are convertible debt when I make them. I have a contract. The company that gave me that contract has a legal obligation to give me the money back. And unless you're a thief or a liar, I will never require you to pay me my money back. Because it's a small world. And if the word got out that Andrew enforces his convertible debt, Andrew's deal flow would die out. I'm not in this business for your 10% interest. Let's go back to Babe Ruth and compare the way he swings and what he's looking to do to 10% annual interest. I know how risky this is. And by the way, why haven't you raised money? By the way, why haven't you paid me back? Because you can't. Things aren't going well. It's harder than you thought. It's taking longer than you thought. And by the way, if it is taking longer than you thought, it's harder than you thought, and you're still grinding, why would I want to take the money I gave you out of the company at the time you need it the most? Like, why would I try to bleed a stone? That makes me a jerk. And jerks don't win deals from founders who have options. And I only want to invest in founders that have options. Because if I'm getting in a deal too easy, I know I'm fishing in a pond filled with everybody's leftovers. So here's the thing, and here's why it matters, guys. And this is not just Andrew speaking or GrowthX. Any venture capitalist worth their weight who's not a wolf in sheep's clothing will not enforce their convertible debt unless you're a thief or a liar. And even then, what would it matter? Because there's probably no money left. So why do I tell you this? And what does this have to do with convertible equity? Guys, it's my favorite way to smoke out the wolves in sheep clothing. Because when you talk to an investor who's willing to invest in convertible debt, then you say to them, well, why don't we just do a convertible equity? And when they push back, you've got to question why. Because the only difference between convertible debt and convertible equity is the legal obligation to pay, which they're saying they won't enforce. So if they really wouldn't enforce it, then they should be okay with the convertible equity. Because the only thing they're losing is the thing they said to you they don't care about. Does that make sense?
Thank you. That was excellent.
Yes, agreed.
Yeah. And by the way, so to the question I was asked, is it rational? We invest in convertible equity all the time. Like, why? Well, A, because we want access to the deals. B, because I don't think there's one right answer. And again, like, if I'm going to get out of it what I need to and want to get out of it, then it doesn't matter that's convertible equity and debt. Because again, I'm never going to enforce the debt, so I'm not losing anything. And so, I'm going to do a lot of work to figure out whether I want to be in a deal. And then I'm going to bust my ass to earn the right to have you choose me to be in that deal. Because just because I'm a VC doesn't mean I have any right to be on your cap table. For too long, the verbs of venture have been identify and qualify. Those are very selfish verbs, and they have everything to do with my priorities. So we're adding a third verb to venture, and that's earn. We have to earn the right to be on your cap table. We do that by being helpful, right? And so I'm going to bust my butt to try to get into a deal. And then I've got to do a whole lot of work to figure out whether I should be in the deal. Whether it's debt equity or straight equity, I'm just not going to get too chuffed about. Okay, now I want to talk about a couple other things that are very practical and tactical as we wind down and have only 25 minutes left to cover a whole lot of material. But this is the stuff I really want. And I'm going to skip to one other thing that I think is the most important thing for you guys to know. Okay, quickly, why you shouldn't just use a form that someone gave you off the internet. And by the way, I'm not suggesting that if you're doing convertible debt or equity, you should hire a lawyer. And as a lawyer, I'm telling you, don't hire a lawyer to do debt or equity. If you listen today, and if you follow up and learn more about VC, you won't have to hire a lawyer to do debt or equity. You should always use a lawyer to do straight equity, but convertible equity and convertible debt you can do on your own. But let me tell you what you need to look out for. I'm going to save you a lot of money right now and a lot of hassle down the line. Okay, we talked about the cap and the discount. There's no form around that. Like, it's market terms. Figure out what makes sense for you and figure out what's in your market. Don't just take a note that has a 20% discount and an $8 million cap or something and think you can use it, or no cap, or just a discount. It can have one, it could have the other, it could have neither, it could have both. It could be any number you want it to be. Just realize that when you set your cap on your convertible debt, you're not setting the price. That's not the valuation of your company, although psychologically it will be relied on by the later stage equity investor. When I come into a deal that has a note outstanding, and 6 months prior, they sold a note with a $4 million cap, and they're asking a $7 or $8 million valuation for me, I'm like, wait, why did 6 months ago you sell it for a $4 million cap, which now is going to be a $4 million valuation when I invest, but I'm having to pay $8 million, right? It's not a valuation. The $4 million is a cap. You haven't sold equity, but psychologically, I'm like, this just doesn't make sense. Like, I don't want to be the jerk, right? So just be wary of that. 2, more importantly, remember I talked about convertible debt converts to equity when you raise the round. It doesn't have to work that way. Just because the form that you picked up off the internet says that it automatically converts into equity doesn't mean it has to. You can have it say, at the founder's decision, I will either pay you your money back or give you the equity. It can say that it is up to the discretion of the investor whether she wants her money back or equity. It could say that you get your equity for the principal, but the interest you're getting in cash. Because don't forget, guys, if you do that 10%, right, that I talked about on the $100, when it converts to equity, that investor is getting $110 of equity, and they only gave you $100 because their interest will also convert into equity unless you think about it and change what your note says because you're being really thoughtful, right? And that's why it's really important. Don't just take the note. Think about it. Should the investor have the choice? Should you have the choice? Should it happen automatically? Should it be the principal and the interest? You get to make those types of changes. So why wouldn't you? Also, the length of it. A typical form from Silicon Valley will say that it's 12 months long. I mean, you're in a startup ecosystem that's more nascent in Silicon Valley. You also may be doing something that's more capitally intense because it has regulatory hurdles. You need more than a year. It's not because you're a lazy founder. It's not because you're not working hard. It's not because you're not a good founder. It's because what you're doing takes longer. Why would you just sign a convertible note that just said a year because that's what you found on the internet? It doesn't have to be a year. It could be 6 months. It could be 2 years. Make sure it makes sense for what you're doing. You know, these are the things that you really, really, really need to be thinking about. Okay? Now, we don't have a very little bit of time, and I would be remiss if I didn't. And by the way, these are all really important things. I think the Startup Junkie guys should invite me back, but that's up to them. But like, we're not going to have any time to go over this stuff because I don't want to miss arguably the most important thing that you guys need to know about. And I'm telling you, it's the #1 mistake that founders make in startup ecosystems around the world that get them checkmated. from the first time they raise money. And that is your cap table, your capitalization table. Who owns your company? Sounds simple, right? Not when you start selling convertible instruments, it's not. Your cap table is who owns your company. And I want to tell you something, guys. Venture capital, big, fast money, means we expect a couple of things from you as a founder. One, you're going to raise a lot more money after you raise our money as early stage investors, because there's no way you're going to get to that multiple billion-dollar exit value by just raising money from us early investors. We assume, as a matter of fact, that you will raise additional capital, which means you will sell more of your company, right? And if you sell more of your company, it's going to come out of your pie. So one thing that I'm going to insist on is that there's enough ownership in the founder so they can continue to sell more of it, because that's the only way they can raise money. And remember, I'm assuming you're going to have to raise more money. A, that's important. B, I also assume that you're not going to pour your blood, sweat, and tears into this company if you are so deluded that your ability to make any more real money out of this company beyond whatever you've made already because of the equity that you have that's vested, that you're just going to say, I'm done. Investors, congratulations, you now own the company. I'm going to go start something new with the rest of my life because I don't have enough opportunity. You've stripped me of all my ownership. I have such a little piece that if I stick around and keep busting my butt, I'm only going to get a slice of a more upside. I'm just going to go and put my chips on a different table. Thank you very much, everybody. Good night. So what does that mean? Cap tables are the most important thing to you as a founder, because I don't care who you are. I don't care what your product is. I don't care what your market is. I will not invest, and no VC will invest if you've sold too much of your company too early, such that you can't raise a lot more money without being way too diluted because of what I just said. That is absolute fact. And it's the number one reason why nascent startup ecosystem founders can't raise venture capital. They've sold too much of their company early because either a wolf in sheep's clothing or way more often, an investor that just doesn't know the non-obvious characteristics of the asset class that you now know bought too much too quickly. Yeah, this is great, Andrew. I'd love to invest. I'm going to give you $1 million at a $2 million valuation. I own, right, a 30-year company, or half of your company, excuse me, $2 million post-money valuation. I put $1 million in. I own half of your company. You have, your oxygen on your cap table has been depleted. You'll never raise venture capital. Nobody will invest in that kind of business because you will not be able to raise a lot of additional capital and stay at an ownership level that's acceptable. Those are the two things. Don't forget them. Okay? And so here's why it matters based on what we're, go ahead.
I'm sorry to interrupt.
No, go.
If you're looking from the founder's perspective, how do they actually gain sight to how valuable that idea or that concept or that business they're about to create? Where do they kind of really put a value on? I'm you know, the VCs always have, if you're thinking about the chessboard again, they have all the mechanics behind the scenes to really kind of put a number on it where they may lowball it or, you know, not give you a fair estimate. How do you, as a founder, really hone in on that number?
You know, valuations are actually pretty easy. They're just set by the market and they're set by the investor because it's pretty simple math. VCs, as part of their investment thesis, they will have an ownership target that they're looking for. So, you know, we want to own, you know, roughly 8%, let's say, at the seed stage. Well, if the round is of a certain size and my checks are of a certain size, you already have all the inputs in your equation solved for. There's no conversation to be had, right? 2 and 2 equals 4. I don't care what you want to talk about, right? And so if I know I'm going to write a $2 million check and I need to own 8% of your company, I just set your valuation. And then market dynamics are going to impact that. the performance of the company, your revenue, if you have any, your growth, your customer, your logos, your product roadmap, all that stuff, that just gets you to the table to get an investment. The valuation has very little to do with that. And so let me tell you something, guys. This is, again, there's no rule or law. It's just well accepted. Post your Series A. You will need to own, as a founder, at least 50% of your company. Post money. You and your full-time active founders. Full-time active founders. So if you started the company with someone else and you didn't bother to have a vesting schedule and you split the company 50-50 and they said, yeah, you know what, I don't want to do this with you anymore, and they left, you don't get to count their 50% of the company because they're not a full-time active founder. Full-time active founders collectively have to own 50% of the company post-money Series A. You also have to have an option pool, which if we have time, we're going to talk about because it's really important. How do you attract and retain the top talent that you're going to need to win this adventure? That's your option pool. At your Series A, that's probably going to be roughly 10 to 15% pre-money, meaning you have to fund that before I give you my money because I'm not funding it. So it's going to be a little more. So when I talk about 50% post-money, I'm talking about 10 to 50% into your option pool pre-money. And don't forget, Series A investors are going to want to own about 25% of your company. I just accounted for a significant amount of ownership, 50%, 25%, 10 to 15%. So if you've sold a lot of your company already, you're dead. You're at your pre-seed stage and you just got checkmated. You'll never raise venture. Won't be able to get through a Series A. And by the way, because funds are a lot larger, they have to write larger checks. You think a VC says, hey, have you considered raising more than that just because they love you? No, they're working their priorities, not yours. They have to do the same amount of work to write the check, whether it's $1 million or $5 million. It's better for them to write a $5 million. Once they decide they're writing a check, it's much better to put in 5 than 1. Because I have to do all the work. The decision is whether I will invest. The bigger check I write, the more money I deploy. That's better for my priorities. Remember the IRR, the internal rate of return. Deploy the capital faster, get it to the return levels faster. So now you're working the VC's priorities when you take more money. You thought you were flattered, you take the money. But guys, this is really, really important. You have to understand cap tables. It's super geeky, it's super unsexy, and you must understand it. It's the number one mistake that founders make in nascent startup ecosystems is losing control of their cap table. And how do they lose control of their cap table? This is how. Because guys and gals, when you raise convertible instruments, you are not selling a piece of your company. I'm going to tell you something you've probably never heard or realized before. The second you sell any investor a convertible debt or convertible equity instrument, you no longer know how much of your own company you own, period. And if anybody wants to disagree with me, then before we get into it, you need to solve this equation for me. X plus Y equals 7. Solve for Y. But you can't. It's impossible. Now you can tell me a range of options that Y could equal, but you can't tell me as a matter of fact what number Y equals. And that's why when you sell convertible debt or convertible equity, you now have an input in your equation that you cannot solve for, and therefore you no longer know how much of your own company you own. And if you're not modeling it out with a spreadsheet, that just like you would do the X plus Y equals 7, you could create a formula to solve for what Y equals in various scenarios. If X equals 1, Y equals 6. If X equals 2, Y equals 5. You can create that same type of spreadsheet for your conversions. Because remember, I give you $100 in a convertible debt. I don't have equity. I can't be on the cap table. I have no idea how much of your company I own, nor do you, because we won't know until you raised your equity. And once you know the price of the equity, and then you know whether I'm converting at that price, or I'm converting at my cap, or I'm converting at my discount, you won't know how much of your own company you own. Because when you raise equity and you have outstanding convertible instruments, you may only get $2 million at your equity round, but you're going to get dilution equal to 2 million plus every convertible instrument you've sold before. So unless you have a spreadsheet where you plug in your caps and you plug in your discounts, and then you model it out, like, okay, what would happen if I raised $10 million at a $5 million valuation, you know, in my equity round, right? And I have 20% discounts out there. I have a 10% discount out there. I have a $2 million cap out there. I have an $8 million cap out there. Once you plug in how much you're raising and what valuation at your equity round, your spreadsheet will calculate, and now you'll see what your cap table would look like if that were to happen. If you don't do that, you will lose control of your cap table. You will not know how much of your own company you own or might own based on the reasonable outcomes of your equity round, and you will lose the game of chess, and you haven't even moved a piece. Now, I know this is super geeky, and I'm getting into it quickly, but I did not want to get off the telephone today, the Zoom, without putting that knowledge in your head. Now, guys, I'm going to show you something. If you're a serious founder, you will own this book. Serious founders own this book. Non-serious founders don't own this book. It's binary. This is by the founders of Techstars and Foundry Group. Brad Feld is one of the reasons I became a VC. He's an incredible investor with an incredible track record. He's a good human being, and he spends an enormous amount of his time putting it to plain English and just helping people like you. Feld Thoughts, his blog, that's where this came from. He used to just blog a ton, and that became this. You can find every subject we've talked about and everything on a term sheet on Feld Thoughts, and Brad will give you his reasonable, thoughtful, seasoned insights about it. There is no excuse for anybody out there, VC or investor alike, or founder alike, to not have this book. And by the way, I'm proud to tell you that the Kaufman Fellowship partnered with Brad and Jason, and now we offer for free an online course called Venture Deals, which you can sign up for. It's a massive person online course, and you go through it with a TA. I used to TA it, and there is learning and exercises that you can go through on your own or with a team. And you do this, you'll have a cap table exercise. You will actually go through various scenarios. So what if you raise this much in debt and this much in convertible debt, and then you raise the price round? What would your cap table look like afterwards? You need to know how to do this. And by the way, it's 100% free for that course. And this book is not much. Venture Deals. Let me tell you really quickly. I'm gonna stop for a minute and we use it's already 25 after. We've kind of run out of time. But the one thing I want to tell you about option pools, guys, because this is something you're not going to hear. This is also practical and tactical. Wolf in sheep's clothing investors will argue that you should have a larger option pool than you have because that translates for them into a lower price per share. Now, I'm not going to get into the geeky math of it, but you'll have to trust me, right? And you can read up on this afterwards. When an investor tries to get you to agree that you need a larger funded option pool, the way the math works out is they pay less price per share. Instead of having an honest dialogue with you about the valuation, they're going to backdoor a lower valuation by talking to you about your option pool, okay? But not you all, because you're here, thanks to Startup Junkie, right? And this is what you need to know. Option pools are nothing other than attracting and retaining the top talent that you need to conquer where you are along your big adventure. Your adventure is long. It's complex. It's multivariate. It's going to take a lot of time. You do not have to solve for all of it right now. All you need to do is solve for the chapter of your adventure that you're currently in. And when you raise a round, the chapters become round to round. And when you are raising money at the seed stage, let's say you price around a series seed, your option pool only needs to be able to fund the ability for you to attract and retain the top talent that you're going to need between seed and A. Why would you need options in a pool for a VP of sales at your seed stage when everybody knows or should know that you never hire a VP of sales prior to your Series A or immediately prior to your Series A? Any investor who's telling you that you need a bigger option pool than you really need to attract and retain the top talent you need for the current place of the adventure you're on right now to just complete the chapter of the adventure you're on right now doesn't understand option pools or is a wolf in sheep's clothing. Here's the other thing. I can't possibly have a conversation with you about option pools unless I know who's on your team intimately and what you're doing intimately. Because what if the founders of the company are the chief technology officer and chief revenue officer? Like, you already have two of the most important all-stars through multiple series of investing. You never use equity where you can use cash. Your option pool is only equity that you need, not want, but you need to have in order to attract and retain top talent. If you've got, as a part of the founding team, badasses, who are sticking around, well, you hardly need any option pool at all. So if you're going to have a conversation about option pool, you need to know what's the talent that you need for the stage of the adventure you're at compared to the talent that you have, and create an option pool that's only as much as you need to attract and retain the talent you need for the chapter of the adventure you're on. Because let me tell you, raise your Series A, have this conversation again, and you're going to have to probably refresh your option pool. Why would you fund it at the Series seed? Fund it when don't fund it before you need to, because guess whose butt it's coming out of? Yours. And by doing so, you're lowering the purchase price of the equity you're selling, which means more dilution to you. Okay? Now, I know some of this isn't going to sink in just from that quick rattling, but that's why you're going to buy this book. And no, I don't get any proceeds. This is not like a sponsored placement. I don't get anything from this other than a world with better founders, which is why I do it. Okay, I'll stop talking. I think we have no time for questions, but I would entertain them anyway.
Andrew, grateful for your time. Would definitely love to do another session as like a Venture 2.0 and go deeper.
Good. Make sure that the Startup Junkies guys' email box just fills up with demands for more of this.
Light us up.
Guys, I'm Andrew GrowthX. If I can be helpful, reach out. Caleb, anything else from you? Anything you want to finish with? Any other questions that are kind of on the tip of the tongue that we should answer before we say goodbye?
Not necessarily. Just to everybody watching, whether here on the Zoom or on Facebook Live, we'll make this video available for anybody that had to jump off or wants to go back through and kind of review some of the content. So I'll be sending that out to everybody that signed up. But that's
Good.
all I have.
By the way, guys, if you're looking at the slide still, that GrowthX cap table tool is a link, and it links to our cap table tool that we built to do exactly what I'm saying you should do. So if you email Andrew at growthx.com, I will send that cap table to you. I will also, because I didn't get into it, but I will also send you my 10-slide framework that I created to help hundreds and hundreds of founders raise venture capital and avoid this. This is the number one mistake founders make when raising venture capital. They mistake being busy for making progress. So if we have another session, this is where we'll go.
Awesome. Yeah, and I'll, if you're cool with that, Andrew, I'll copy you in that email to everybody when I send out that video. That way it'll be easier for everybody to reach out to you.
That sounds awesome.
Awesome. Well, we appreciate everybody for joining us today.
Thank you, guys.
Thank you times a million.
Thank you for your time.
Great questions. Absolutely. I thoroughly enjoyed this. I am grateful for the opportunity to be here with you guys today. So to Startup Junkie, thank you for knowing that this stuff is important to founders, not just pitch decks and demo days. And I look forward to seeing everybody again soon.
Awesome. But have a great day.
Cheers, guys.
Have a great day.
Guys.
Bye.